People often talk about bulge bracket banks like they're these large, immutable behemoths, when in reality, that's not actually true, and we can look at history to see exactly how this changes. The term bulge bracket was coined in this book called House of Morgan, and they dubbed a couple of bulge brackets. The first one, which we still recognize as a bulge bracket, is Morgan Stanley, and they're actually the only one that still remains on this list. Back in the 60s and 70s, Morgan Stanley was the definitive investment bank. Some of their competitors now, like Goldman Sachs, as well as Merrill, which is a part of Bank of America, wouldn't become bulge brackets until the 80s. Next, we have First Boston. They used to be a bulge bracket, and then they bet huge on the junk bond market in the 1980s. They eventually folded and got acquired by Credit Suisse, which eventually folded and got acquired by UBS. Next, we have this firm, which I think is Kuhn, Loeb & Co. They had a capital crisis in 1977 after being a leader in the industrial and consumer space. And they were acquired by Lehman Brothers, which famously went bankrupt in 2008 and was acquired by Barclays, which still is a bulge bracket. And the other OG bulge bracket was a firm called Dillon Read. They were sold to Barings Bank, which was sold to Swiss Bank, which was sold to UBS, which is maybe or maybe not considered a bulge bracket. I think this really shows how bulge brackets are often incentivized to take risk. Lots of them grow under really good market conditions, but might blow up when they mismanage that risk. And it also shows us that eventually everyone gets acquired by a European bank.